You two are like two of the loveliest people in the world. I've told you this many times. So I'm so grateful to know you guys. You're wonderful people and your parents as well. So you are doing the world a good service by cloning yourselves and
Thank you.
introducing another. Okay, so we've had discussions in the past couple of years where we've discussed real estate things, but then real estate and beyond, what I call wealth beyond walls, because there's just a lot to figure out when it comes to personal wealth, finances, all this stuff. It's a really big C. You guys own your own home. You're in Toronto. We've did some revising of your asset portfolio on the real estate side, and now we've been talking of late with just structuring what happens to the next 10, 20 years of your life and how to make that make a lot of sense. You're both in IT, and Andy is a corporate owned entity. Mariana is an employee. Therein lies some opportunities that exist, and Andy's been taking advantage of some of that because when you're a corporation, there's a lot more things you can do to be creative in tax planning and strategizing. So I want to talk about that through this discussion as well.
Actually, Donny,
Yeah.
I just stopped being an employee and became an independent contractor under Andrews
I love
Corporation.
it. I love it.
Yeah, you're poking ideas, and I follow you on YouTube, and like, oh, we should look into this. Oh, what are we doing here? We're trying to
So
figure it out.
did you get the why didn't I do this sooner moment yet? Have you been there?
Yeah, I said it to a friend already. I said, why didn't I do this before?
Oh, I've been telling her she
Yeah.
should think about it for a long time.
She didn't want to tell you you're right, Andy. So that's what happened.
That's true.
Yeah.
No, he's been supporting it a lot with the whole logistics. He's done this for a while now.
On the earning side, when you make that transition, if all things are the same, you're working for the same kind of clients and doing the same kind of work, the earnings are generally larger because you could say the security's not there. Like you don't have a full-time job or you have a steady whatever. But safe jobs aren't safe. That's
Right.
like first of all, let's identify that. And
Yep.
this way you've eliminated some of the bloat, some of the things that you don't want to pay for. When you're a contractor, you can control a bit more about where your money goes. And most importantly though, you can control how taxation is going to affect you when you do this way. The tax man is the greatest creditor. It's the largest thief of our wealth. We need taxes for sure. I'm not saying we should avoid taxes. You should evade taxes, but you can optimize taxes. And what you just did right now is one step closer to optimizing for taxation.
Plus, I just realized too that it was gonna take me longer to earn a little bit more staying a full-time employee.
Yep.
We all know companies will pay employees as little as they can get away with, right?
Sure.
A lot of times it comes down to factors beyond our control. And so by working under your own corporation, you have a lot more control. And you say too, you can take on some interesting tax strategies.
I love it. It's the truth. Like, this is capitalism. This is what you do. What's the lowest I can give you so that you can be loyal, you can stay true to the job, but know that I'm going to make multiples of that on the other side. I just want to make sure that I've limited my costs. So congrats.
It does take a period of time to adapt to the new way of thinking, but it is possible. I think it's never too late. That's something that I have learned from you, Donny. It's better to do it now.
I'm a big believer in compounding in many ways, and compounding works in both directions, in the good and the bad. And if you don't do something, and you should, and then time goes by, you just compounded the wrong way. You just compounded the decision of delaying. So you got a little man in the house, and with that comes responsibility. At least you're thinking about this for your kids, thinking education. And it's almost like when you give birth, the moment you're signing birth certificates, they're almost like, here's a brochure for an RESP. You want to be a good parent? Start contributing to this thing right now. And of course you want to be a good parent. So you're like, yeah, this sounds amazing. And it's always the gift of free money attached to an RESP that gets our attention and inevitably gets our signatures and our funds.
Yep.
Does Noah have an RESP set up?
He does.
Okay.
He does. We didn't start immediately.
We topped it up to as if we had started when he was born. So
Got it.
Yeah.
Okay.
we maxed it. Yeah.
Okay.
The thinking is that government doesn't give away money very often, so this is the right thing to do, right? You should contribute whatever you have to. There's a certain sweet spot such that the government will contribute their maximum, and then that's it.
And a lot of us do that. Like, just so you know, full disclosure, my kids have RESPs as well. They have, so I did the same thing. I don't want to get technical on the RESP side of things because this is a discussion amongst friends, but you put in $2,500 a year and they give you $500 in addition to that to save. That's basically how this works. No more per year. If you want to add more to it, you can. I think you guys have said you did, because that will unlock compounding, because you have a bigger number in the beginning and turns into a bigger number in the end. But the grant that they give you, it's still like is a max per year. So $500 is their limit. And you're right. People look at it through that lens saying it's free money. Nobody's lining up to give me free money, but this group is. I'll listen to them and I'll take it. And we do that.
Mm-hmm.
I want to ask, are you happy with what it is? How well do you understand it? Do you have any concerns about it?
I personally don't know if it's the right mechanism. If we can help with his education, why not? I know the RESP will not pay for all of it. We actually are also putting some money aside on an interest for him to cover the expense. But what I don't like is those restrictions. I believe we can transfer. If it's not used for education, it can be transferred to an RSP, I believe. We would like him to make use and go to school, go to university and do it. But who knows? Like, he will be an adult by then and
Right.
make his own decisions. Yep. So what I don't like is the restrictions around the use of that money. That's personally my view. So I just want to explore, see if there are other mechanisms. What I do like about it is that the contribution the government does, and also the tax break.
Because the gain goes to the kid, and a lot of it's shielded for a long while. Yeah. And do you echo those same thoughts?
Yeah, pretty much the same thoughts. We realized, as you were alluding to, there's at a certain point, once the government kicks in their max, there's not really much more point in us putting more into the same plan. We're not going to get any more money out of the government. So That's why our advisor recommended we set up an educational trust for Noah. So that's what we did. I understand it gives a lot more flexibility than, say, the RESP. So,
100%. Yeah.
I don't know. Yeah.
Anything...
Do we keep going or not? I don't know.
Is there something better out there?
I do believe there is. But it's very personal. Look, if you just want something that requires very little thought, and the free money is something that you think will be valuable enough that it will solve this problem for when your kid's 18, 19 and ready to go, and you think there's a whole bunch of restrictions, but if you think there's going to be in Canada as well, because they have to go to school in a qualifying post-secondary institution, so what they're going to become, what they're going to be like when they're older, what are they interested in, if it fits into that mold, it'll work. Ultimately, it's designed to make sure that you do the things today, contribute small, to at least stash it away for a specific purpose being education. But if something happens to the kid, right, like touch wood, so the benefits of doing all this are gone, and you got to pay back the grant, if I'm not mistaken. If you don't use this for qualifying post-secondary education on your kid or your grandkid, or not at arm's length, if you apply it in that very specific window, then it's fine. But anything that differs from what that is, the grant money is going to be gone. So the gain, the reason why you put in these accounts that have restrictions on what you can invest in, what you can do with the money, all the benefits would be gone. To pull it back out into an RSP, like, very simply, you got to have RSP space, first of all. If you do not, then you're out of luck. Okay, like you have to take it back in cash. Again, you lose the grant, and then you probably pay tax on it on your own tax levels. If it has to unwind in a way that you didn't want it to, I think it's ugly for that reason. I also don't know that I believe that the future, like next generation or the one after that, will put the value into university in such a way that we did. I don't know. I went to a entrepreneur conference. This is years ago now. You guys know Gary Vaynerchuk?
Yep.
Okay. So Gary's on stage, and this man walks up, and it was a question answer time. Man walks up with the mic, and, hey, Gary, my name is whatever. And he's got his phone out, and he's recording this conversation with Gary. My daughter's going to Columbia University in New York in the fall. She's going to be doing marketing there. She's excited about this. Do you have any words that you want to share or wisdom? I'm going to record this and let her watch this. And Gary's like, dude, are you serious? He's, yeah, I would love to do this. I'm going to be honest. If you want me to be honest, I'm going to be honest with you. He goes, yeah, I want you to be honest. He's like, don't go to school. He wanted to press pause. What are you doing? You're going to go into debt. You're going to waste your time. You can learn more relevant things off of YouTube than you could from a professor with a textbook from the 90s in this modern day and age. Why would you waste your effort? Go work for someone. Go intern somewhere. Get the experience. That's going to make a difference. Don't do that kind of stuff. And it got me thinking, there's a lot of jobs that exists today that didn't exist when we were going through education
Right.
and all that. Content creators, right? What is that? But that exists. There's people who have careers that got nothing to do with a history degree at a prestigious university in the States that comes with $120,000 tuition cost. Doctors, engineers, you have to go through university. I don't want my doctor operating on me if he didn't go through the process. I want him or her to have gone through the pain of learning. But there's going to be a significant number of people that are working, entrepreneurs, who don't need to go through that channel and are going to be reconsidering, I think, the entire institution of university. Is it required? I went to university for a business degree. I don't know that it mattered in the end. My wife went to school. Her degree, it didn't matter for what she was doing. If your job requires, or the job you're heading for requires a university degree and a master's and a PhD, of course. But there's a whole part of the industry, part of the market that doesn't need education. It doesn't value education as much as the university itself does. So if you've got a kid who's not going to go down that path, or if that changes the way they feel about university, the RESP fails.
For sure. And I agree with you. The vision we have for our kids is not exactly the vision they'll have for themselves at some point in time. I completely agree. And that's what is actually getting me to think. And Andrew and I very briefly have talked about, is this the right thing? What if he chooses to do something else?
So let's talk about something else. So what I prefer, and it's right for me, it has to be right for the person as well. There's a lot more discussion that has to go on, and there's got to be pros and there's reasons why. But I'm going to share with you what I've been doing, which I think might be relevant to you. I know our mindsets are very similar. A lot of strategies I've been working on or working with lately, a lot of them use a tool to accomplish certain results, and the tool has often been whole life insurance. Doesn't even matter that it's insurance. The fact that whole life insurance has this, there's a trade of a premium for a guaranteed outcome, a death benefit. The fact that those two things exist gives you opportunity to create strategies around those very fixed, very rigid rules. So in my case, not for me, but for my kids, what I've done was utilized a whole life insurance policy that pays dividends to be the vehicle for my kids, not just to pay for education, but it's going to go beyond there. We're talking about wedding. We're talking about down payment for a home. We're talking about investing in a business if they want to go that way. It's got long-term implications that go beyond just single purpose. Okay, and I'm going to share a screen and show you how I see these results playing out. But just to lay the framework here, got two daughters at the time, 10 and 13 when I started the policy, so a bit later than I should have. And I decided that they were going to go in for $5,000 a year, so it's more than the 2.5 that you're probably paying right now, but you guys have said you contributed more than that, so maybe we're on par here. I'm putting $5,000 a year into each of my kids. I'm calling this education fund for now just so we can compare, okay, apples to apples. So the education fund, which is an insurance policy. And I was able to, like you guys, I was able to start a year early. I backdated 1 year, so I was able to get 2 years of savings at the start. So they each contributed 10 grand to their accounts. Every year going forward, I've got to pay $5,000. Here's how insurance works in a nutshell. The whole life insurance policy. You're buying insurance, you're buying death benefit. If something happens, if I die, you're going to pay out this much money, a death benefit. That's what insurance is. Just like if you get in a car accident, you have insurance that you pay each time. In case I get in a car accident, you're going to fix it. Same thing. In case I die, you're going to pay me this amount of money that we agreed to in advance. Every day that you're alive brings you 1 day closer, theoretically and statistically, to eventual death. So the insurance company that holds a contract knows that I've got to bring up this person's premiums. I got to get this number to be this really big number at a very specific point in time. In Canada, it's age 100. I've got to get this number to be here at age 100. So I've got to build it one direction. I've got to build it up every single day. Now, if the policy owner decides that they want to sell the contract, the insurance company is going to buy them out and say, whew, you let us off the hook from having to pay that big number in the future. In exchange for that, I'm going to give you some money so you can go away. And that buyout number, because you guys are math nerds like me, it is the net present value of that death benefit today. So what is that death benefit then? What is that worth in today's dollars right now? Assuming I'm going to make more premium payments, all these assumptions, what is the value of that death benefit to me today? That's the buyout. So every day you're alive, that becomes more likely. Therefore, your buyout goes up in value every single day. Okay, we're going to call that cash value. There's no cash value. It's not a deposit account. That's what the net present value is of that death benefit. That's it. The fact that this is very rigid makes this make sense. So if you got that part, I'll move on. If you didn't, ask some questions and I'm happy to explain or elaborate on that.
No, we are actually using that mechanism, so we're familiar with it and how it
Okay.
works.
So then moving forward, same thing with the kids. They contribute money. I contribute money, and I'm making them pay for this as well, just so you know.
Oh.
They're going to contribute money, and I'm contributing money, and we are watching the progress. We are watching how that cash value goes up every day, every month, every year. It only goes up. So we're watching how that's going, because the money that's in that account, they benefit from dividends that are being paid by the company who has access to their money. They're paying them almost interest each year. It's not a fixed
Right.
amount, but they're paying them each year.
Yeah.
And that goes on to compound because they're earning interest on interest when they leave the money in the company. Okay, so the cash value is increasing every single day. So their money's not locked in there. So eventually they're going to keep contributing each year. They need access to money at some point in the future. They would never stop this progress. What they're going to do is take a loan. They're going to use this contract as a collateral for a loan and borrow money against the value of this very sure, very guaranteed contract. Because at some point, this contract will pay a death benefit and you can collateralize that fact. So they're going to borrow money against the value of their contract and pay for the things they need to do, including school. I'm going to pull up an example to show you some numbers to make this real. You can see exactly what I mean. I'm going to pull up my little ones. Okay, so here's her coverage. She's paying $5,000 a year, and it's broken up into two different sections. I don't know how much I want to get into it, but she's paying $5,000 a year towards insurance. And she bought death benefit of $310,000. So I'm not doing this for the insurance part of it, really, but if something happens to her, they will pay me $310,000 to deal with that loss, tax-free, like the next week. That's an important component to all this as well. Even more important than that, though, is the fact that if something happens to her during her life, between now and her meeting somebody, getting pregnant, if she gets sick and will no longer qualify for life insurance, or will be super expensive, I've solved that future problem should it arise because she has insurance coverage for her entire life now. So that's important to me. Okay. Let's go in here. These are called illustrations. This is what projecting forward, given current rates, given current assumptions, here's what we can expect. So in 1 year, she would have paid $5,000. In 2 years, she pays $95,000. This is every year she's paid $5,000. I want to draw attention to this part over here. Total cash value. In the first year, she put in $5,000, but the cash value of her contract is just under $4,000. And if she wanted to, she could make a request, or I could, because I own this contract. I could make a request for up to 90% of this value to come back to me as a loan. I would do that instead of withdrawing money from this contract because my money is going to earn money and I'm going to unlock compounding. You can't see it right now, but compounding is going to be absolutely breathtaking in a number of years. So I don't want to stop that. Instead, what I'll do is if I want to spend money, I will borrow money from the contract, spend it, pay it back. That's what I would do. Okay, so $5,000. She's going to be 20 years old in 10 years. $5,000 every year. Would you look at that? Her cash value, she put in $50,000. She got insurance coverage, and now she has access to $59,000 in cash value. The contract is worth $10,000 more than what she contributed to it, with no risk of ever going down. It'll only ever go up. On top of that, what started off as $310,000 of death benefit is now almost $700,000 death benefit. You've noticed it goes up every single year. How much would pay out in death benefit? And because the death benefit's going up, that's the reason why the net present value, the cash value, is going up with it. Fast forward, she's 20 here. Let's go to when she's 30 years old. So 30 years old, she would have contributed, like every year it's $5,000. She would have contributed 20 years times $5,000, $100,000. Look at that, $156,949 in cash value, and her death benefits over $1 million. I want you to compare the difference between this number and this number. She put in $5,000 this year, and she will have access to almost $12,000 more in cash value in a year. Even if all she wanted to do was take $5,000 in a loan from this number, pay this number, it'll increase by more than that every year. The beginning takes a little bit of time, and this is all happening because of compounding. The beginning takes a little bit of time, and this is a pretty boring policy. This is designed as best we can for a kid. What you would do for you, Andy, and what you do for you, Mariana, is different. You can make these numbers even larger for yourselves. But for a kid, given that it is a child, this is the best we can achieve with the numbers that we wanted to contribute each year. So my daughters had money over the years just sitting in their savings accounts from birthdays, Christmas, things like that. So I made them contribute to this. This is their policy. So much as I could, I'm going to use up their money. It's not an expense. It's going into a contract that they own, and it's doing this for them. So in year 10, at age 20, let's say she wants to go to university. She has access to 90% of $59,000 that she could borrow from her policy, or I could, and we just cover that back, pay that back with interest or whatever you want to do, knowing that next year I'll contribute $5,000 more and she'll have access to $7,500 more.
So, Donny, a question in terms of ownership of this. So,
Yes.
this is, you said you own, but it's for her. So, how does this work in the policy, and what happens if you die?
So she's the beneficiary of her own contract, but I've noted that my wife would be the one responsible for this, and then absent those two, it goes to my kid.
Yeah.
But they've got everything in trust, so there's
Okay.
somebody there to ensure that they're not getting this money before 18.
Not just till they're 19, kind of thing, or
Yeah,
whatever.
exactly, until they're adults. But I've earmarked this for university for the most part, right? That's what I've done here. I've put in the $5,000 that I'm saving towards this is available to her. She'll have access to $60,000 by the time she's there, ready to go to university.
I forget what we set aside. We did some scenarios when we were planning this. How much money do we need to send our kid to school? And $60,000 wouldn't be enough for 4 years.
Fair enough.
But it's going to go a long way.
It would go a long way. And these numbers can change. Like, this is what I needed. So we do have RESP money. And I also want to make it sustainable. I don't want to crush it. Every year it goes up. So I know that the first year university might be the most expensive, but I don't need $60,000 for the first year. Maybe I need 30. I don't know at that time. Maybe it's 20. I did these numbers too. My numbers were showing up over $100,000 as well. And this is like assuming worst case scenario. They go different province. They live in dorms and all. They do all this stuff. And that may not be the case. Like, I know when I went to university, I lived in Toronto and I went to university in Toronto. I'm looking at maybe $20,000 tops is what I paid for my 4 years of university.
That's what she wants to do. She wants him to go to school in Toronto.
Yeah, we all do. We all want to be near our kids for sure. This provides for, it definitely is a buffer for a while. And all it took was $5,000 in an asset that I could always access the money if I needed to.
It's tremendous growth. And I like your idea of having them contribute. We had a piggy bank. We added up all the money and we said, I guess we should open a bank account. I don't know.
We separated it and we have told Noah, let's figure out how we can make it grow. It's just sitting there waiting to do something.
The kid's 6, he's got $1,000.
And it's going to keep happening. Just plan for it. If you do things like this, you provide an opportunity for, rather than TD Bank or whatever, RBC, rather than put it into an account that's earning nothing, show them this. If we do a good job of educating our kids on how to use this tool to accomplish their own needs to finance life, man, the sky's the limit. I know I do a lot with my policies, and it sounds like, Andy, you understand the value, and Mariana, the leverageability of a policy and to achieve certain goals. I do a lot of lending, and my policies back me up on a lot of that lending because I'm not really using cash I have in accounts. I use my policies a lot of times to borrow from those to make more than that. In the meanwhile, if you want access to it in year 5, in year 7, because you have an opportunity to make more money, whether for yourself or for your kid, you can do that, knowing that you have not stopped the compounding that is happening uninterrupted of your money. You're using someone else's money to achieve some of those goals. This contract gives you the framework to execute on that stuff.
And that's what I like. There are two things that get highlighted to me when you show this instrument, right? Like the flexibility of it, because as you said, it could be for university, it could be for a wedding, it could be for a house, it could be for whatever it is, right? Like versus the RESP, which is only for education, and with some flexibility with a lot of but, right? And the other thing that I like is the fact that you said that the kids will not be denied an insurance after this. That's another huge advantage I see going through this mechanism. We talk about it all the time, right? They're unpleasant topics, but we gotta be prepared. The other question that pops in my head, Donny, is do you still have the RESP going?
I do have it, but I have not contributed to it in a few years. I'm not adding to it. Given the hybrid that I've created, only because I got knowledge in this new space that I believe is the superior space for me. I don't want to contribute to the things that contributed. I want to fund this instead. And one is that we're saving money for the kids and it's doing its thing. And there is some grant money. $500 doesn't really excite me. And I'm not saying that it should excite people. $500 is a good number, but I'm going for larger numbers for my kids. I would rather not be governed on what I can contribute to. Let me decide based on all the things I can do, including lending, for example, if I wanted to. I get to decide everything I do with those funds, not just a RESP qualified investment in Canada.
Yeah.
This new way of working with numbers, it gives me such an advantage to speak to my kids about this. It'll give them education. So never mind the RESPs paying for education. I'm going to educate myself through this insurance program just to make sure that they see how money moves.
For
They can
sure.
start thinking like a banker.
Yeah.
So
No, it's definitely a learning process. It doesn't stop. I think we just recently learned that too.
there's just better ways of doing things. And the fact that the masses say this thing doesn't mean that they're right. We take it as gospel. Yeah, you should maximize your RSP. I don't think you should, especially if you're not an employee anymore. The benefits to doing the RSP, for example, they're not as strong. If you can save on paying maximum like taxes at the highest tax bracket on self-employed income or at the personal level, okay, maybe you can talk me into that. But if I can't save the highest marginal tax rate and I'm deferring this to pay the highest marginal tax rate in the future when I eventually pull it out, it's not a good sale for me. I'm not interested. I would rather have full control today using tools like this, which offer a lot of tax-free benefits and growth. I don't need to go that way, but everyone still talks about it. When I'm on Twitter, every financial planner out there, you'd be an idiot not to maximize your RSPs every year. That's such a awful blanket statement. It's not true. That's not what we see or hear, and so we think we're foolish if we do something different from what everyone else is doing.
Yeah, no, I agree with you that I think at a minimum we should explore the options and figure out what works best for each family.
I would agree.
I'd love to talk to you further about that as well. Just the whole corporation, we're both working under the same corporation now.
That's so good. Mariana, when you start bringing in revenues into that corporation needs you now financially. You're someone whose life can be insured by a corporation using after-tax dollars that are a lot higher in a corporate environment. That's another discussion. You're doing the right thing.
For sure. I just started a couple of months ago, so we're gonna just give ourselves like maybe another 3 months, 4 months to figure things out, and then make some decisions towards the end of the beginning of the year.
Sweet.
Yeah.
Andy, how's your policy working out?
Yeah, it's good. I just haven't really thought too much about it, to be honest.
You haven't started using it to take advantage of yet?
No, I don't think I can yet, but maybe I can. I don't know.
At about year 3, I got really aggressive with it. There's more opportunities. It's amazing when you have access to capital, opportunities somehow find you, then you get to be selective as to what it is you do with it. So you're close. It depends on the company that you're with. And I guess I won't ask it on this call, but there's companies that will allow the next day and some companies that will say minimum a year.
Okay.
Yeah, I think we have to wait a little.
Okay. But just know that, dude, the best is yet to come. Once you start seeing some of the results.
I'm so frustrated with just the amount of money that's just sitting in the corporation still. And Mariana's now contributing. And how do we make the most of that? Does she need to make a big RSP contribution this year to offset? I don't know.
Yeah, it's all good problems. It's just a matter of, I look at a big puzzle, right? And you just got all these different pieces and you just got to, how does that work? How does this fit? There's ways to optimize taxes that does not equal evasion. You owe it to yourself to try and identify opportunities to pay less tax, for sure. If you don't believe that, I don't know why we're here, kind of thing. But you owe it to yourself to try and figure out how to keep more of what's yours. And then within there are structures. There are strategies, and everyone's different. Yours is very different. The fact that Mariana did this year, it's another gear in there now. All good problems.
We're excited.
Work in progress, Donny.
I love it all. Thank you very much for doing this chat with me. Anytime you want to call me, you always do, but you know you can text me, call me, and I'm happy to answer any questions. And if you want to talk more about the solution we just talked about in this chat here with the kids and using an insurance policy to achieve some life goals, we can definitely have that chat after this.
Awesome.
Thanks so much.
Thank you, guys.